There are a wide range of different absolute return strategies, and I think it's important to understand what each of them intends to do to help understand what they should bring to a portfolio. In the case of the Absolute Insight Multi-Strategy Fund, we aim to bring stability through having very low volatility. We aim to preserve capital, and we aim to be that part of the portfolio that's easier to predict in terms of future returns and therefore makes it easier to plan. So within absolute return funds, we try to smooth the investment journey compared to a relative return fund. And the way that we do that is firstly by not having an index benchmark that we have to track, and secondly, therefore, having a lot of flexibility and the ability to make active decision making within the fund. For example, if we start with cash, cash would be always preserve capital, always positive, low volatility, therefore your ideal absolute return asset. However, there's no upside in cash, and therefore, especially given today's low cash rates, we would typically target something higher than cash. But when targeting something higher, necessarily we have to take some risk. Unfortunately, there is no free lunch. And in terms of getting to that target, there are different ways. One is we buy and hold, invest in a cyclical asset. But what we know from these assets is they go up and down with the market cycle. Therefore, it would be the advisors or the portfolio managers' job to try and buy low, sell high, in order to add extra value to the portfolio. Whereas what an absolute return approach tries to do is smooth the investment journey, and we do this by having the flexibility to make active decisions within the fund. There are similarities as well as differences between absolute return funds and hedge funds. In terms of similarities, they all have flexible mandates, they take a very active management approach, and they therefore don't have any constraint by a benchmark index. However, the differences lie mostly in the regulation, in the sense that hedge funds are unregulated offshore funds, whereas absolute return funds are regulated. And it's through that regulation that we are allowed to sell absolute return funds to the retail market, whereas hedge funds are only available to institutional investors and high net worth. What that also means is that your minimum investment amounts is typically much higher for hedge funds than it is for absolute return funds. And also the type of risk that you can take is unconstrained in a hedge fund, whereas the regulatory structure puts some limits in terms of the risk that you can take within an absolute return fund. One technique we use within absolute return funds is that of pair trading. And this is the concept of trying to isolate stock-specific risk by removing all the general market risk. And typically how we do that and how we do that at Insight is we use fundamental bottom-up equity research to identify a lead position. And that lead position can either be a positive view on a company where we would go long, or it could be a negative view on a company where we would go short. But then before we put that position into our portfolio, the manager has to identify a hedge to go with it. And in the case of the hedge, it can be one of three types. It can be a general market hedge, it can be a sector-specific hedge, or it could be a relative pair trade, where we effectively take a lead position versus a competitor. And what that means is that we don't care about what the actual stock position does, whether it goes up or down. What we care about is the fact that it goes up more than the market hedge, or that it goes down less than the market hedge. So therefore, in a rising environment, market environment, as long as our stock rises by more than the hedge, we can make a profit. But in the same way, in a falling market environment, as long as our stock falls less than the market, we can make a profit. A key reason to invest in absolute return strategies is because it removes this timing element of investment. And even if we look at year-to-date returns, Japanese equities are up 34%, gold is down 18%, US Treasury rates have gone up. And therefore, it's difficult if you invest in those assets to make the decisions when to go in, when to come out. Whereas with absolute return, we're more indifferent in terms of when exactly one invests. Therefore, any time can be considered a good time. So what absolute return brings to your portfolio is stability through having low volatility. It brings an uncorrelated asset to your portfolio, therefore increased diversification. And effectively, that means it enables better planning because it gives one more predictability of returns.